All right. Welcome everybody as you're joining the line here. You're stuck with myself and Jack today. No Gary, who we're gonna start calling One-Eyed Willie. Come on, Starbucks reference card, Jack. First person who can name what movie that was from. Um, Jack will give you a Starbucks card. One-Eyed Willie. No Google allowed. Anyway, he had to have eye surgery again. Uh, that because the first one didn't go right. So he's currently in post-op right now. And then anybody wants to wish him well, he's going to be lying on his stomach for the next. There you go, Jim. That's right. I can always count on you. Starbucks gift card coming your way. Sorry, Jack, for obligating you.
That's all right. I was waiting anxiously. I mean, surely
Yeah, it's
someone
like, come on, this one was a layup. I mean,
isn't it
yeah.
on like TBS like every other day, or I guess maybe closer
Yeah.
to
And
Halloween.
it's and
Thanksgiving.
it sucks me in every time, it sucks me in every time. So the anyway, if I had to be lying on my stomach for the next 7 days, as Gary is, for the second time in a couple months, I don't own a gun, but if I did own a gun, I would be asking my wife to lock it up because I might not. Now, so someone's going down. It's gonna be me, it's gonna be the dog, or it's gonna be her. So we wish him well. So anyway, not a whole lot that I am aware of in the political happenings or current events. I think inflation, moderately down, but who knows what's going to happen with interest rates. It still wasn't hitting the target that they were going for. I think in terms of um, what what are broader economic trends that we're seeing out there as we're starting to see, kind of the almost getting to the mid-year result. I think within the BGW client base, there's some pockets of people that are down, um, primarily in areas where it sounds horrible to say, well, I would expect it to be down. But restaurants, hospitality down a little bit, just based on, I think, people kind of normalizing back the eating out piece and pulling back a little bit. And I think the other place, in general, staffing companies down, anywhere between 25 and 40%. But what's tough about that one is that, if I'm thinking through, that as an item for my own planning purposes, typically that's going to be a bellwether of things to come, and at the same time, they had because there was such a labor shortage, they had a pretty good run there. So, I think the real data point for them is going to be more like, hey, how does it feel right now relative to 17, 18, in terms of revenue, stuff like that. And then shipping companies, down as well. But again, it's what's tough to say about that one is, very similar to the staffing companies. Is it down because it sucks, or is it down because, people kind of finally made up um, the shortfall that they had in inventory? So it's like, I finally now have enough stuff, that I'm not having to, you know, do an emergency purchase. So outside of that, I mean, everybody's kind of flatter up. So anyway, that's kind of what we're seeing. How about you, Jack, before we kick into things here?
Yeah, I mean, absolutely. There's also I wanted to mention there was a report that came out the other day, which I just kind of caught my eyes for a moment, which was and the first statement is not shocking. U.S. households continue to feel pinched by inflation in late 2023 and into 24, even as price pressures ebbed, the Federal Reserve reported this Tuesday, with most Americans saying their financial situation had changed little in the last year, while parents reported times had gotten harder. About 72% of adults were doing at least okay financially as of the fourth quarter, per the Fed's annual survey on household economics and decision making. Once again, it's in the eye of the beholder. And, I'm sure I could find and do a Google search as to kind of the opposite, where, things are okay, things are leveling out. My understanding is that the Fed isn't going to do anything in the very near future. And meaning lowering interest rates because they're not seeing the end results or the progression in reduction in inflation. I am not an economist. I know that my grocery bill is still pretty high every time I go to the grocery store, even though I'm one of those people that went in to get 5 things and somehow I end up with 15 out the door. In even the delta between that has gotten more expensive. So and just other little things. And I see people deferring um, kind of purchases that they might otherwise make. Although you hear other things, for example, the race this weekend, the Coca-Cola 600 apparently is officially sold out, and for the fourth year in a row or third or fourth year in a row. So it's just I can report on all kinds of things, but really, again, it is in the eye of the beholder. And I think um, for now, it seems like everything is okay and things are and I'm not aware of, well, I guess another factor of that is bankruptcy filings remain low, but I think that that is the optics of that are deceiving, meaning that you go through a formal bankruptcy in order to deal with the orderly liquidation or continuation of the business in orderly fashion to deal with creditors that are hounding the business, pay me, pay me, pay me. And so you try for a restart paying 30, 40 cents on the dollar and then hit a restart or you liquidate. But there comes a point where there's no reason to do that and all has lost essentially. And so why go through the formalities of a bankruptcy filing if it really isn't going to make a difference in the end? So from my perspective, I think it's a misconception that bankruptcy filings are down because businesses are being more successful. But at the same time, I'm having less conversations than I have in the past about, okay, what if I can't make payroll? What if this? What if that? And so I don't know, Adam, if you're seeing the same thing with your clients as far as, okay, the questions that they were asking 6 months ago, a year ago, 2 years ago during COVID seem to have dissipated with respect to, I don't have enough dollars to go around to pay who I need to pay in order to continue with the business.
Yeah, no, that's a good question. I think all that with the exception of people being the couple isolated pockets that I talked about being down, we haven't run into those issues. But in those businesses that are down, I think I'll just give you an example. I had a meeting with a client yesterday afternoon that was just talking about, hey, we're gonna have to make some cuts, and it's gonna be painful and to the bone and stuff like that. And it's like, I think what the discussions that we're having is kind of less around, hey, I don't have enough money to fund payroll, and more around, we talked about these issues on prior webinars, but I've got some cash. I have access to lines of credit. I've got maybe some retained earnings. And if I'm down, you know, I could finance, keeping the band together. Like that's something that I could do is blow through my cash reserves in my line of credit, keeping the band together. And the problem with having a lot of cash availability and a lot of line of credit availability and using it in that way is that you use it. And then find out that it's sort of like I know that my youngest son does not listen to webinars, so he will not mind me using him as an example, but he's in a terrible relationship right now and he's afraid to break up with his girlfriend, and like I told him the other day, I'm like, you think that you're doing her a favor by sparing her feelings, but you're actually doing her a disservice because you're not allowing her to move on with her life by hanging on. And I think when people lull themselves into a false sense of security around keeping everybody around together, that's really what they're doing. Is the other people are missing out on an opportunity they might have been able to take. Like you're justified, well, I've kept them in a job, but you're also kind of doing a disservice to everybody else that's going to be left. That otherwise, now may have to take a pay cut, that wouldn't have had to, had you made some decisions earlier. So I think that's a long way of saying like look, if you are down and you're dipping into retained earnings and kind of evaluating, oh my God, I'm gonna have to make cuts. Like it sucks. Like I'm not gonna sugarcoat it. Having to make headcount reduction sucks. Like nobody wakes up in the morning and says, you know what I want to do today? Layoffs, Jack. Said no business owner ever because you kind of like it you feel bad. It's an ego bruise. You feel like a failure, but same time I would say get over yourself, and I think really evaluate who is my core keeper team, In other words, like, am I really cutting to the bone? Because very few, if you just follow like the normal distribution of team member performance, if you're going to tell me that 100% of your team is all-stars, you know how many all-stars I think you really have based on that statement? Freaking none, because you're a terrible judge of talent. So, you kind of got typical distribution, 25% here, a broad 50% in the middle, 25% at the bottom end, not advocating to do anything, but it's like, don't tell me that 100% of your team is vital. What it really is you don't want to have to do their job and you feel bad. I got it. I feel that same way too, but it doesn't mean that you shouldn't do something. So I think that's more the counseling that we're doing is saying, look, if you have dipped into your retained earnings quite a bit, like at least do yourself the favor of saying, you know, to another Starbucks gift card for the person get this one. Jack's like, shit, I haven't bought a whole lot of those. You shall not pass. Like what's your line in the sand, that you're gonna say, okay, that's it, get below this. We're doing it, that's what we're encouraging people to do.
Wow, it's been 10 seconds and no one has put up the answer. So, okay. Two random thoughts, neurons that fired as you were talking, and then we'll get back to kind of what are here to talk about today, which is one is you had, man, now
Jim, you're killing it, man. Again, that was a layup.
yes. So two things. One is you mentioned line of credit that in times that are good, it is good to go and get that, because when times are bad, then you're going to have problems. So if you have the opportunity to, and I think that's what helped a lot of people, business owners and individuals, that they had lines of credit, that they had HELOCs that they were able to tap into, that maybe were unused or seldomly used and didn't have a large balance on them. So something to consider. The other thing is, when we're talking about layoffs, is that you may not have, as a business owner, have intentions of discrimination as you're going through as to who you're going to lay off, but you need to be mindful of your constituency, who you're considering laying off, that might come back to you with claims of discrimination, whether it is gender discrimination, age discrimination. So there are certain things that you need to consider and roadmap when you're considering layoffs. And again, not with any intentionality in doing that, but it's just the fact of the matter is that the person that needs to go may be over 50, maybe a female over 50, and the people that you're keeping are males that are under 30 or 30 years old or so. So those kind of things you need to think about when you're going through personnel changes. But yeah, I agree that it's a difficult decision, especially with what I call the legacy employees, the ones that have been around for a long time, in saying, okay, we need to make a change. In some of the more fortunate circumstances, it may be that there is self-acknowledgement that that is the case. So working on or recently worked on a situation where the CEO of the company went to the owners and said, I'm not able to proceed with this. You need to find someone that is better at this because of the way the business has grown. So a self-realization. I will tell you that is the minority, super minority of circumstances. Usually people are not willing to do that introspective view of themselves to say, maybe I'm not the right person for the job anymore. Maybe I was in prior days, but maybe not so much. Maybe there's a different role for me. Maybe I've become the VP of marketing or the VP of operations, where I'm not the CEO anymore, and my duties are reduced, but I can focus on that job rather than everything that goes on with the business as a CEO should be involved in. So again, just some tangential thoughts about that. Adam, I don't know if we want to maybe go a little more formally into incentive stock options. And so, to talk about the difference between a qualified plan, non-qualified. We talked a little bit about stock appreciation rights, maybe talk more about phantom stock, which is really just a bonus program, and maybe also deferred comp a little bit, just so because people are beginning to understand, or that's becoming more prevalent. I see with saying, okay, we're going to put together this plan so that way you are compensated, but it's a future benefit. We do a lot of sports law in my firm, not in my office, but a lot of these coaches, the NCAA coaches, the professional coaches, what brings them in is deferred compensation plans, and doing some really, and so our estate planning, our wealth planning, wealth strategists in the firm help them navigate through all of this stuff when you have universities or professional organizations coming at them and saying, okay, here is your total compensation package. This is cash, this is bonus, this is stuff that we're going to give to you down the road, and it will grow over the course of time. And here are the tax consequences associated with that. So I don't think we need to get that deep into it, but I think that because it's in the vocabulary of people these days, so it seems, as an alternative way of compensating, we probably should go into that a little bit. But I'm speaking a lot out of turn and out of my lane, because really a lot of that is tax driven. But so where do you want to start today as far as going through this? Do you want to go back to kind of the qualified and non-qualified and just kind of go through what those things are?
Yeah. So what's hysterical about that, Jack, is that what the audience doesn't know is the conversation at the beginning was, hey, you got this, right? We're going to go over your areas, right, Jack? He's like, it's all tax stuff. And I'm like, yeah, but you got it. And then he does this to me. Anyway, yeah. So just as a recap, for everybody, if you missed last week, we there, I think the trend that we're seeing is that, people are looking for, and that's why we've had Kevin Monahan on and a few other people that talked about compensation structures, is that, everybody's kind of looking for, really, really looking to solve for two problems, right now. Problem number one is, hey, I need a succession plan at some level, and I'd love to be able to turn it over to the employees or trusted people. What's the right way to do that? And I think the second thing they're looking for is like, okay, how do I attract and retain talent and reward them, without going broke, and kind of create some sort of incentive mechanism to get people to stick around. And what we heard from Kevin Monahan a couple webinars back, which I think is, very aligned with our own experiences at BGW, the observations that we've had within our own client base. And I'm sure Jack's experience, with friends, I mean, not at Shoemaker. I mean, because, at Shoemaker, they have the perfect incentive program that is highly motivating. But anyway, it's the short-term incentive plans don't really work, which are really bonuses based on performance. What does work is, longer term incentive plans, which is what we've been talking about. And at the same time, what I can say is based on my experience with longer term incentive plans is, so when I was 23, my dad told me that he'd bought me health insurance, and I was like, oh, thanks. Like,
Happy birthday.
I know, like, in hindsight, I'm actually very thankful that he got me health insurance. At the time, I'm like, which is kind of how long-term incentive plans feel to employees, because it's delayed gratification, but they do really work, as people start to see the payouts. So last week we talked about employee stock ownership programs, and then we also talked about one form of, because I think Jack and I both believe that giving people real ownership, try to shy away from that. Um, if you can, that should be like your last resort, not your first go-to move. Not necessarily because like, oh my gosh, um, you know, now you're giving up control and all that kind of stuff. It's just more like the downside consequences vastly outweigh the upside. um, because you can get to the same upside, if not better, with none of the downside with the programs we're talking about here. So what we talked about last week were stock appreciation rights. We're not going to cover off on those that much, but to Jack's point, the other things that are out there are um, you know, qualified incentive plans and non-qualified incentive plans. So why don't we start there? Because those terms get thrown around a lot. And what's funny is like, you can have like, well, I've got a phantom equity plan. It's like, and it can be qualified or non-qualified. So it's like people think that these are like one or the other, when in fact it's more like it's a descriptor of a plan. So why don't you talk about the difference between a qualified versus a non-qualified plan and why I might pick one over the other?
Yeah, so the basically the designation is, imagine if you do a qualified plan, then you get certain benefits. And the IRS basically has said this, if you do these certain things, then you are deemed a qualified plan. You have certain reporting requirements and those kind of things. I mean, in either case, it only is applicable to employees. You can't have outsiders. So a lot of times you have directors that might be given stock as part of their compensation as serving on the board of directors. But I'm sorry, for qualified, it is only employees. For non-qualified, it can be outsiders as well. And I have a cheat sheet that my one of my colleagues gave to me. So I'm going to read off of it so I don't mess this up, because again, I am out of my lane in dealing. I know what kind of the results are and things like that, but let me just share with you. So an employee or director exercising a non-qualified stock option recognizes ordinary income on the date of exercise of the non-qualified stock option on the excess of the fair market value of the stock at the date of exercise over the exercise price. So you have a set price, you have a price that's at the date of exercise, and then you pay ordinary income tax on that. The company receives a corresponding tax deduction at that time. An employee will be subject to payroll tax withholding at the time of the exercise, but a non-employee director will not. In comparison, in a qualified plan, actually, I'm going to move this over here so it looks like I'm actually talking to the screen. Okay. Here, I just created my teleprompter. All right. An employee normally does not recognize taxable income until the stock is sold under a qualified plan, assuming certain holding periods are satisfied. Capital gain treatment will be available on the excess of the sale proceeds over the exercise price paid for stock. However, if the employee is subject to alternative minimum tax, he or she may be taxed immediately because the difference between the exercise price and the fair market value at the date of exercise is an item of tax preference for AMT purposes. I went way into the weeds about that, but just understand, I'm trying to share that, an ISO, a qualified incentive stock option plan, is very formalistic. So there has to be a written plan document. It's approved by the board of directors. It's approved by the shareholders. And there's other rules and regulations associated with that. It's smaller businesses are not going to use this specifically because there are costs associated with the development and the continual maintenance of this kind of program. As far as non-qualified, I don't see a whole lot of those, simply because if you're going to go non-qualified, then you may as well just put together a different incentive program, whether it's phantom or, stock appreciation rights like we've talked about before. So, but there is benefits to having a more formalistic plan, even if it's non-qualified, because then everybody kind of knows the rules and everything else. And so that's kind of my perspective on those two. I don't know if there's anything you want to add to that from a tax perspective and
It,
or
it,
fix anything that I may have totally misstated.
no, it's actually funny because you went into all the tax specifics, and I was going to dumb it down Barney style and just say, qualified, typically we're doing that for everybody, period. And there's, and you can't like say, Jack, you're an amazing person. You're going to get a little bit extra over that other guy. Whereas non-qualified, you know, is not like I can single out, people, and I don't have to be, I have to be legal, but fairness, is not one of those legal requirements. So typically you're going to see a qualified type of plan when it's like, Oprah, everybody gets a plan, you know, um, you're typically going to have a non-qualified plan when it's like, hey, I want to reward a certain group of individuals, based on their performance, to get them to stay around. That's that. I mean, all tax issues aside, that's typically how we see the application between the two. Meaning, like, hey, if I only want to reward certain people's, guess what? You made the pick. It's called non-qualified. So that's the way I typically think about the distinction between the two, independent of the tax benefits.
And don't hold me to this, again, stepping way out of my lane, but I think under a qualified plan, if you get terminated and there's certain vesting and then you have to exercise them within a certain period of time, I think under non-qualified, termination of employment may terminate the rights to exercise. So I think
Yeah,
there's an acceleration in a qualified plan.
yeah, that's right.
Okay, good.
Yep, you nailed it. So how about we talk about phantom equity or synthetic equity, because people hear about that a lot as well. And you think, ooh, like, does a guy dress up in a sheet, like a phantom? Like it like
Yeah, there's
and
all kinds of names.
somewhere, some guy just, cashed a quarter for me and Jack because he trademarked, that name, somewhere we owe him a royalty payment.
Yes, definitely. So, and the reason why it's called phantom equity or, other and any other nomenclature is because it is not really equity. It's not ownership in the entity. It is a mechanism to reward employees based upon a calculation as if you were an owner. So, it's not when we talk about in the LLC context, an economic interest owner that has, and can treat that distribution to them as a distribution as if they were an owner and has certain tax benefits because it's derivative of the members' ownership interests that the economic interest comes from. This is really just a fancy calculation as to, well, I mean, it doesn't have to be fancy. It's just that it's based upon the performance of the entity. So you say, okay, you have phantom equity. We're going to treat you as if you were a 10% owner, not a 10% economic interest owner, because that's very specific, but as if you owned 10% of the stock in the business. And then at the end of the day, if you were a 10% owner and you were going to get money based on the net earnings of the business, then this is what you're going to get. However, instead of being a return on your investment that can be treated with at a lower tax rate in most cases, in many cases, depending on how long you've had the stock and all those things. Short-term gain, long-term gain, all those things still apply. But would have applied. But in this instance, you have money that's given to you and distributed to you and it's ordinary income. It's a bonus essentially. And so what that does is a couple things. And again, I'm stepping out of my lane, but I've been doing this for a little while, so hopefully I'm not going to butcher it. But what happens mechanically within the financials of the business is that even though the calculation is based upon the performance of the business and as if you own the interest, an actual ownership interest, it is an expense to the business. So it's kind of a double calculation. You get to the end, and then you say, if you were a 10% owner at this point, this is what you would get. And then you go back and you pull that money out as an expense, and then you have a pie that is a little bit smaller, and that's what gets distributed to the other owners. So basically, let's say it's 10%. So then now the 90% becomes the 100% of the distribution to the owners because they are the true owners. And the net income would be less because you're expensing that payment that you just made to that 10% owner. So that's one way of doing it. Sometimes it's a more complex calculation, whereas, okay, well, even though we're paying you this 10%, we are going to calculate your 10% as if we have already paid you that 10%, and then that's what you get, which is kind of very circular. And I think it's one of those kind of diminishing, recalculate kind of thing. But I don't see a lot of those, but that is a possibility that if you wanted to make a net situation for that 10% or so. Again, getting into the weeds, but hopefully I didn't mess any of that up, Adam.
No, you did it. You did a good job. No need to save you on that one.
All right.
So that, it's just another form of a formal agreement. And, typically people are going to use phantom equity as Jack described, which is just a more formalized bonus program that has a kicker if there's a sale or change of control in the company. It's typically meaning like, hey, if we give above a certain hurdle, y'all get a certain percentage of the profits of the company, payable as a bonus. And then if we sell the company, you're going to get X. If it's just an equity award, meaning like, hey, there's no bonus component that's separate, and this is just simply going to be, hey, if we sell the company, you're going to get something. Phantom equity or a stock appreciation right works equally the same. Like it doesn't matter, kind of which one you use in that scenario. They both behave the same way. So let's get into deferred compensation
Actually,
for a
before you do
minute.
that,
Go
Adam,
ahead.
just a few more nuances that I was thinking
Yep.
about, which is understand that the phantom equity program is, it can be a plan, but it's a contractual arrangement between employer and employee. So just like anything else you put together that is bonus-like, it could be subject to forfeiture. It could be subject to a clawback, meaning it's been, okay, or reduction or changes, all those things that, may not be permitted in other, like a qualified plan and those kind of things. Also, from the employee standpoint, normally when you are given stock, either you pay for it or there is keeping track of the fact that you didn't pay for it, and there's tax consequences associated with that. With this, because it's a bonus program, the employee is not putting money into to acquire this right, so that there's no upfront cost, there's no really tax basis essentially. My understanding is that in a nuance to that, well, first of all, so it's easier on the employee because they're not investing in the business. Secondly, I think that the rules are, if you have, let's say this bonus vests on today, or let's say June 1st, but the payout goes into the future, then I think you start getting into deferred compensation issues, which is it 409A that I think you start getting into
Yeah.
and again, going into the weeds, but understand that, I'm not suggesting that it's an easy thing to do to just put this together, slap it together and say, okay, we're going to treat you as a 10% owner. There are consequences based on how you implement the program based upon the payouts and things like that. So I don't want to oversimplify it. I don't want to overcomplicate it, but understand it's not as simple as saying, I'm going to pay you as if you're a 10% owner and be done with it. And then and you pay the money and there's no consequences to either employer or employee with respect to deferred compensation. So
Cool. So you ready to hop into deferred compensation?
yeah,
All
go for
right.
it.
So this one, so deferred compensation is it sounds stupid. I mean, it's just that it's deferred. It's basically, you know, I I I think the easiest way to think about it is, you know, it if I was in you use it as a tool for rewarding, could be everybody, but usually it's a certain class of executives or some sort of performance incentive for something. But it's really like, you know, if I worked for, General Motors, this would be the equivalent of my pension. Like that's the way I typically think about deferred compensation, which is, hey, you're amazing, and then upon retirement, you're going to get some more money. That sits outside of the normal retirement plan. So so it's just, and you're rewarded for, sticking around for a while in order to actually get it. So usually there's a vesting period associated with it. So it's typically used as a method for having an ancillary form of retirement for your key people, outside of any other plan that you have available. I think what gets confusing about it a lot of times is that, again, it's deferred compensation. So like, Jack, you're amazing. You had a great year. Here's your bonus. By the way, when you retire, you just earned another 25 grand that I'm gonna, when you retire. I mean, that to boil it down, that's basically what it is. The thing that you hear a lot about, and this isn't a knock on, I need to check the attendee list. Any insurance people on the attendee list? No. Yay. um, where
Turn off the recording button too, right?
Turn on the recording button. No one else can listen to this now. So, I mean, again, it's not a bad idea. But I'll explain where it's got a practical application in a minute. So, what you hear a lot about, like, so it's not as bad. I mean, I literally just got a TikTok video sent to me today about the Augusta rule. It's like, oh, again. But anyway, occasionally I get my guy talked to me about deferred compensation and key employee and golden handcuffs about. It's like, who's he work for? Northwestern Mutual. That's not a knock on Kevin Monahan. He's a great guy, by the way. But like, okay. So basically, what they're talking about is, when you think about deferred compensation, and if you can think about it in terms of it's a pension plan, at the end of the day, that's what it is. You either have a funded pension plan, meaning, and by funded, it means like, you know, if I tell Jack that I'm putting 25 grand away for him for retirement, I'm putting 25 grand away for him for retirement. Like, not versus a partially funded plan, which would be, Jack, I'm putting 25 grand in retirement for you, and I put in 10, versus unfunded, which is, how the Boatsman family paid for college. We'll figure that shit out when it happens.
Yeah,
Yeah.
and it comes out of the current cash flow that you are going on too,
Yeah, no,
right?
I'm sure that's not what happened with the Santaniello family. Because, honestly, if you, again, going back to Gary's line on the face down, if you told me how much I was going to have to pay for college, and have that all in the bank ready to go, by the time that my kids are ready to go to college, I also would have said lock up the gun. So anyway, the because I need to, fawn off a kid. Just kidding. Don't record that. So, or you have unfunded. So basically, with the funded insurance, with the funded plan, that I'm putting cash away, that where that makes the most sense, for people is that I've got a lot of discretionary cash flow, meaning like I actually can afford to set aside 25 grand. Usually with with deferred compensation, the reason that I'm not paying Jack the 25 grand is because I don't freaking have it. But I want him to stick around, because Jack would rather have it today. Let's be honest, versus like, oh yeah, 30 years from now, you're gonna give me 12. I don't even know if you're gonna be around in 30 years. So, typically most people don't have it today. But if you do have it today, where deferred compensation plans can be funding them can be interesting is that, you know, again, asking for a friend, because I know Jack and I are about the same age. The If I owe Jack $25,000 and I know that I've got, a 20-year window between when I said, Jack, I'm going to pay you 25 grand and when I actually have to pay him, well, if I were to invest the money today, then I only need to invest $10,000, watch it accumulate. And by the time that I have to pay Jack 25 grand, that's investment income, that I made that my actual cash outlay was only 10 grand. The rest of it was all market performance, that got me there, to then pay out Jack. And then when I pay out Jack, it's a deduction for me in income, to Jack. But that's where they make the most sense, is that if you get, and again, could be life insurance, you could just invest the money in this, like the stock market, when people hear about cash balance plans, those are technically qualified plans, but at the same time, it's the same concept. I'm basically setting aside a bunch of money today, that will grow over time to have an accumulated benefit at some point in the future. But that's where, when people talk about, the tax benefits, they're it's a little bit of a misnomer, because they think, oh my gosh, I can do this and somehow there's this incredible tax benefit. Not really. Because what happens when I've got an investment account or a life insurance policy with the deferred compensation plan, what I can do is I can say, here, I don't get a deduction for when I'm paying it in. However, if I want to borrow against it, I can, and put cash in my pocket, and there's no tax consequence associated with that. Then Jack dies. There's a payoff, but it goes to pay off the debt, that Jack took against the cash surrender value. So it's not, air quote, really tax free. It's more like I borrowed money and then I died. And then the money got paid back when I died. So it's kind of the equivalent of reverse mortgage, in that sense.
Yeah, and not from an M&A, mergers and acquisitions context. So this is kind of how I view them, whether I'm on the seller side or on the buyer side. So on the seller side, it's a liability essentially. So as Adam said, many times it's an unfunded or partially funded. Most I see more often unfunded. And so, having to work your way through that through due diligence and explain, okay, the positive spin is, well, I haven't had to burn through cash and I've kept people on board and kept them incentivized without having to pay out cash. So that way we would have better cash flow, better net working capital, all those things. On the buy side, it is, oh, so you have an unfunded pension plan. What are we going to do about that? I think maybe we should take part of the purchase price proceeds and fund that. So that way we are reducing the liability that we are taking on potentially by bringing these people on board. A lot of times, and that's more so in a stock sale, in an equity sale, in an asset sale, typically that's treated as, all right, that's an obligation that you created. And unless the buyer is going to take that on, and have an offset necessarily for for that unfunded nature. Now here's where the conflict occurs. So you have essentially a unfunded pension plan that for a certain aspect is earned but deferred. So it's not subject necessarily to forfeiture. However, what is the value of that? And is there going to be a payout on the buyer side if they inherit that? Likely, yes. And so it's a negotiation within the negotiations as to how you're going to treat this liability, especially if you're going to bring that employee on board with you as the buyer. And so you have this negotiation as to what is the current value, the current liability of this plan, and then how you're going to treat it moving forward. And are you going to use part of the purchase price proceeds to fund it, and all those things. So it gets a little more complex also in the M&A context, but it really comes down to who is going to assume that obligation moving forward. And many times in an asset deal, the seller is required to deal with it prior to closing so they don't inherit any issues down the road, because a lot of times, and I've said this before, the federal government, state government many times doesn't care, and they have the power to go through a transaction. And if there's a tax issue, an employment issue, uh, they can go and seek the buyer who now has the assets and paid fair market value for those assets. They'll go after the seller too. But from their perspective, it is that is wonderful that you guys, seller and buyer, have this contract with each other and has these beautiful provisions that talk about indemnification, and there's a holdback. So go deal with that amongst yourselves. But at this point, someone needs to pay us or pay that employee or pay that liability. And we really don't care who does it. And we're going to come after both of you until it gets done. So there's limited circumstances that can occur, but as buyers counsel, we're always concerned about that. So we're doing things like doing tax clearance checks with the NCDOR to make sure that the individual and the company don't owe state taxes, because that can come back at us as the buyer down the road. So again, off on another tangent, but understand that there's an interrelationship in the buy sell, meaning an asset transaction or a stock transaction in an exit strategy, succession strategy, and all that stuff.
Cool. All right. So we're coming up with a couple minutes left before the top of the hour. I think if I was to put a recap on the last two sessions that we've had, um, you know, when we think about employee incentives, it's sort of like, I think in terms of like, hey, let's kind of do some gateways here. The only time that I probably would say, so the first route I need to pick is, look, do I want to sell externally? Do I want to turn it over to the folks? If the route is turn it over to the folks, I'm above, 25 employees, an ESOP is that's a viable strategy, viable strategy. There are other alternatives, but that's definitely a viable strategy. If I don't meet those attributes, meaning like I'm not close, to wanting to turn over the reins, and I also, and I don't know if that's the route that I'm going to go, then the fallback would be, hey, let me put some sort of incentive plan in place. And then I'm just picking the flavor that I want out of everything that Jack and I talked about here. Generally, if I'm looking for tax deductions today, it's got to be a fair plan, you know, meaning it's a qualified retirement plan, or alternatively, it needs to be a phantom equity plan, meaning like I'm giving out current year profits to people in the forms of bonuses, in which case, like, hey, I'm not, in a qualified plan, I'm getting a deduction for it today, but the employee is not picking it up until the future, in a lot of cases. Whereas in a phantom equity plan, I'm getting a deduction for it, but Jack's picking it up at income. So like it's tax neutral. I'm just transferring the burden from myself to Jack, because I paid it to him. If I've got some sort of profits interest associated with that. Everything else, it's basically delayed gratification. Delayed deduction for you, delayed income pickup for the employee. And, kind of the last option, which we need to talk about because we so believe it's the last option, would be the equity piece, which again, I think Jack and I probably share the opinion that only makes sense for like us. And the only reason that it makes sense for us is not because it makes sense for us, it's because it's such an accepted freaking industry norm that you'd have to like you're talking like revolutionizing the industry, for doctors, attorneys, engineers, other professional practices. You'd have a pretty massive culture shift because otherwise, if we were starting from scratch, we'd have done all this stuff. So we're saying, don't trap yourself like we got trapped. So anyway, I'm just saying, not a shoemaker. You know, they've got this figured out. I'm just saying for
Yeah.
everybody else.
And I don't want people to think we're not empathetic to the situation where
Yeah,
it is that, okay, I don't have the money to do a bonus. I don't have the money to put together a plan. So this is the best that I can do because at this point it's just paper for me, but it means something. It means that the employee has skin in the game, and which is fine so long as you understand the consequences. And I go back to the story that I told last week in prior sessions about the four fraternity brothers that got together, and then, but all became very wealthy, but one of them just wasn't doing what he was supposed to do, and they wanted to kick him out, and they had to pay him a ton of money based on the issuance of stock and the redemption formula that they put together in their shareholders agreement. So, as long as you know what you're doing, you do it in an informed fashion. So I don't want to say that we're anti issuance of true equity in every circumstance, but as you said, kind of as a last resort, and or you really have to have someone that you want to give somebody skin in the game, and that they will earn it and that it's properly managed so that it's, and there's no one has a crystal ball to say that 10% is now worth $10 million, 20 years down the road. It's just there's no way of doing that. There's hopes and prayers and dreams and aspirations, but no one really knows that. So but yeah, for us, yeah, you have to convince us that that's a good thing for you and your business and your family and your co-owners. So
cool. Well, anything else we want to leave with a parting shot here, Jack?
I think we covered it pretty well. I've just gone to throw out a teaser for what we think we're going to be doing next week, which is my some of my tax people, and so we have a affiliate of the firm called Shoemaker Advisors, and they are, I don't want to call them a political action committee. But I mean, they can walk into the U.S. Capitol whenever they want to. They have literally street cred to be able to do that. But they assist businesses with dealing with and navigating through political issues, whether it's licensure, whether and those kind of things. But um, they have described to us internally at Shoemaker what is a tax cliff, that if I think it's the Jobs and Security Act, don't hold me to that, is not
Yep.
renewed at the end of this year, it expires, that there are all these tax consequences. And so have one of my colleagues from Shoemaker Advisors that I think we're going to tee up for next Thursday to go through those things, to talk about, okay, if this is not renewed, this is how you're going to have to treat business expenses in 2025. And so all these things that may be coming our way potentially, but and if they don't, at least you know about them, and then maybe we'll come to find out how you're supposed to be doing it currently if you're not doing it currently correctly, kind of thing. So I think that's what we're going to do. So there's that teaser for next week.
Yeah, that's right. So just remember it's coming because it is a cliff. All right, awesome. Well, thank you very much, guys. I appreciate it. Hopefully Gary will be proud and hope to have him back next week.
Sounds good. Thank
All
you.
right, thanks, guys.
Happy
Bye.
holidays.
All right.
Bye.